Good morning, everyone, and welcome to our 2022 Halftime Market Insights webinar. This webinar replaces the former quarterly video series we were doing. We've switched to a live format to add a little bit more energy to make this an interactive experience for all of our listeners. So welcome and thank you for joining us this morning. What we'd like to do over the better part of the next hour is share with you our insights into not only what has happened in the market so far during the first 6 months of 2022, but also what to look for. There's a lot to unpack here. We can talk Fed policy, we can talk inflation, certainly market volatility will be part of the discussion. A lot of things to touch upon. We have the help of all of our senior analysts to assist with that conversation. Now, before moving forward here, what we'd like to do is a couple of housekeeping items. First of all, questions will be at the end. We have several questions which we have received from clients over the last couple of weeks, which we will lead with. And any other questions that you would like to cover, please submit those using the Q&A feature. Alternatively, you can email us at research5@marquetteassociates.com. At the conclusion of today's session, this will be recorded and uploaded to our YouTube channel. Please use as you see fit or share with your colleagues. Now, introductions. My name is Greg Leonberger. I'm the Director of Research here at Marquette Associates, and joining me today are our senior analysts who will help lead the discussion for the respective sections. Jessica Naviscus will cover the U.S. economy. Frank Valli will review fixed income. Evan Fraser will cover U.S. equities, while David Hernandez covers non-U.S. equities. The alternatives portion of this discussion this morning will be led by Chad Schaefer, discussing hedge funds, Josh Cabrera, who will cover real assets, which includes real estate and infrastructure. Last, but certainly not least, is Brett Graffey, who will lead the conversation on private markets, which consists of both private equity and private credit. So with the housekeeping items out of the way, introductions out of the way, we're going to jump right into things. I'll hand it to Jessica to talk about the U.S. economy.
Thanks, Greg, and good morning, everyone. We will go to the first slide here. All right, great. So the macro story really starts with inflation. It's why the Fed is increasing interest rates, and then it's those two pieces together, higher prices and higher rates, that are threatening growth and labor market strength and leading to fears of a recession. June CPI data came out last week at 9.1%. That was up from 8.6% in May, and it was higher than consensus expectations of 8.8%. This chart shows how steep that increase has been and really how long it's been since the U.S. has been anywhere near these levels. Month over month, prices were up 1.3%. That was largely driven by energy prices. Gasoline alone, which is a very visible component of inflation, was up 11% in 1 month and drove roughly 40% of the total month-over-month increase. Some good news is that energy prices and other commodities have come down from their peaks. So in the energy complex, oil, nat gas, and gasoline are all off of early June peaks. Metals prices are below where they started the year. And ag commodities, so corn and wheat on this chart, those flow through to higher food prices. Those have been falling. Markets are still very volatile. With gasoline, we are in the middle of peak driving season now, and supplies are tight. So a weather disruption or a broader reopening in China, which would increase oil demand, there are a number of things that could still move numbers around. So we are step toward the way out of this. We have to align supply and demand. So in this case, demand destruction from higher prices and fears of a recession is actually a good thing. Along with lower commodity prices, inflation expectations have been falling. The break-even inflation rates shown in this chart is what the market is embedding in 5- and 10-year inflation-linked bonds. These ended June in the 2 to 2.5% range, which is essentially in line with the Fed's long-term inflation goal of 2%. This means investors kind of more or less think that long-term inflation is under control, given what the Fed's done, what they're expected to still do, and the response from consumers. With inflation, expectations actually matter quite a bit because inflation can become self-fulfilling. So if you expect higher prices to continue, you may buy now, further increasing demand. Workers might demand higher wages. Businesses might increase prices more than they have to in anticipation of future margin compression. So expectations resetting is actually more tangible than it seems, and certainly another positive. So a couple of the positives out of the way. Commodities, inflation expectations coming off. Overall consumer sentiment is still very weak. The University of Michigan surveys are well known. They're kind of our go-to measure for consumer confidence. And in June, the headline sentiment index hit an all-time low. So lower than COVID, lower than the GFC, lower than any other recession over the last 45 years. Preliminary numbers for July did come up slightly off that bottom, but overall still very low. And again, this is mostly inflation. So consumers are facing higher prices across the board at the pump, in the grocery store, utility bills, rent bills. Consumer spending has held up so far, but consumers have had to dip into their savings. Personal savings rates are down, and that is just not sustainable. Along with weak consumer sentiment, business sentiment is falling. So firms are facing the same issues that consumers are in higher costs and higher interest rates. And when business outlooks get more uncertain or negative, that flows through to the labor market. So the labor market is still very strong. Unemployment is still incredibly low at 3.6%. There are still many more job openings than unemployed workers, and voluntary quit rates are still high. But you are increasingly hearing about large companies, and not just in tech, but across industries, slowing hiring or going through layoffs. There are articles and anecdotes about firms rescinding offers. And initial jobless claims, which is what this chart looks at in the purple, initial jobless claims are one of the leading indicators for the unemployment market, and those have started to tick up over the last couple months. So ending on rates here. So this is calculated by Bloomberg based on Fed funds futures and options pricing. So we show two different time periods. The end of May is in green, and mid-July is in blue, with the July numbers then capturing the change in expectations following that June CPI number. So unsurprisingly, with higher inflation, we're now expecting higher rates and sooner. The FOMC meets again next week. There was some talk of potentially a 100 basis point increase at that meeting. Consensus is now back down to 75 basis points, and then another 75 basis points at the next meeting in September. We wrap up with, as current expectations are, for 1 to 2 25 basis point hikes between the November and December meetings. And then rates are expected to peak early next year with potential rate cuts later in the year if slows to recessionary levels.
Thank you, Jessica. I think that there's some elements of good news in here, and in that long-term expectations for inflation are starting to abate just a little bit. We've seen commodity prices come off the more recent highs, but still concerning, obviously, is the absolute level of inflation, as well as some of the sentiment numbers that you shared with us. So a little bit of a mixed bag on the U.S. economy. And I think the natural transition here, as we talk about U.S. economy moving to capital markets, is talking about rates. I think rates have really dominated the headlines. And I think what you'll hear from our analysts, both on the fixed income side as well as the equity side, is the impact of rates, among other macro factors that have driven markets. So with all that said as a background and kind of leading with rates here, Frank, I'll throw it to you for fixed income and let you share your thoughts on not only what we've seen through the first half of the year, but what to watch for the rest of the year.
Thank you, Greg. So 2022 is the worst start ever in fixed income markets. So the Bloomberg Ag is down over 10% year to date. Just for context, the prior worst year ever was negative 3%. But what this does mean is that we're going to have higher fixed income yields going forward, and this could be the end of the low yielding fixed income environment. So jumping ahead to the next slide, higher rates have been the primary driver of negative returns here in 2022. The benchmark 10-year has been up, was up in the second quarter, but that's kind of gone down a little bit, and those rates have mediated as some of the inflation fears have dissipated. Where we've seen the real big move has been on the front end, where Fed policy has really pushed the curve higher, and now we're going to expect another 75 basis points to be raised in July. The end result of these is we've ended up with a very flat Treasury curve. So in addition to higher Treasury rates, we've also had wider spreads. So spreads have been wider across the board for most fixed income sectors, the one exception being non-agency mortgages. So after a long period of tight spreads, we're finally starting to see some attractive valuations in spread markets. So with the higher yields in fixed income, bonds are starting to act like bonds again. So bonds and risk assets were correlated during the first half of the year, but now bonds are starting to act like bonds and providing that hedge to risk assets. So finally, on opportunities and risks, where do we see some of the opportunities? So credits is starting to look attractive. So fundamentals have been deteriorating a little bit, but overall they remain strong. Where we're really excited on credit is valuations. So investment grade spreads are above 150 basis points over treasuries and high yield above 500. MBS is attractive for the first time since 2008. The Fed has stepped back from the market and we've seen spreads widen. And with little chance of repayment, MBS is starting to be attractive. And finally, tips. Earlier this year, tips were very expensive with high inflation expectations, but those inflation expectations have fallen. Now it's cheap to add inflation protection into your portfolio. A few things that we're concerned about. One, slowing global growth. If the Fed and other central banks act too quickly or move too far, this could push the market into recession. This will be detrimental to risk assets. But one thing you can do to help hedge your portfolio is to continue to hold duration. If the market does move into recession, you should see falling rates, and duration will provide that hedge. And then finally, the geopolitical landscape. Russia and Ukraine crisis continues to go on. There seems to be no end in sight for that conflict to end. And also COVID and the government policies, what's going to happen there, and could that continue to put pressure on markets and slow down any growth?
Thank you, Frank. And I'm going to find myself saying this a lot as we wrap up each section, but it's really a mixed bag of good news and bad news. The bad news is what bond investors have seen from returns over the first half of the year. The good news is that the bond market is back to being the bond market, meaning that there's actually some meaningful yield to be derived from most fixed income investments at this point. The diversification story of treasuries versus equities is back, which we did not see during the first half of this year. And then from an overall valuation perspective, rates are higher, which means that prices are more attractive, whether we're talking spread sectors or just even treasuries for that matter. So with fixed income out of the way, let's talk equities and again, some of the same themes that we've already heard about in the U.S. economy, as well as fixed income, you'll hear about here in the equity section. So we're going to talk about U.S. equities and non-U.S. equities, and Evan Fraser will take us through the U.S. section first. So Evan, all yours.
Thanks, Greg, and might be less of a mixed bag on our end. I think maybe it's all bad over here, but no, obviously it's been a challenging start to the year for equity markets, as most of you are probably aware. If you can go to the first slide here, Greg. There we go. Yep. So here we're looking at the 6-month return for the S&P 500 index to start each year over the last 5 or so decades, and what we can see is that 2022 marks the worst first half for a year for the S&P since 1970. The index posted a return of negative 20% to start this year, and there's really been nowhere to hide within the U.S. equity space. Growth benchmarks are down nearly 30% amid that backdrop of rising rates that Frank discussed. Value benchmarks have held up relatively well, but are still down more than 10%. And it's a similar story across the market cap spectrum. So small cap indices, similar story there, facing a lot of headwinds. And we'll get into sort of what's driving this performance in greater detail in a minute, but certainly been a rough start to the year for risk assets, to say the least. I want to go to the next slide. Awesome. So from a sector perspective, almost every segment of the U.S. equity market is down since the start of the year. Here we're looking at, June quarter to date and then year to date returns for each sector of the S&P 500. And as you can see, more growth-oriented sectors like consumer discretionary, communication services, tech have exhibited the most pronounced pullbacks, while more defensive areas of the market like utilities and staples have been flat to slightly negative to start the year. And obviously, the more growth-oriented sectors, given strong performance in recent years, make up a larger performance of, broad market benchmarks, which helps explain kind of why indices like the S&P have struggled this year. You'll notice that the one bright spot on a year-to-date basis has been the energy sector, which is a small part of the S&P, but it's up over 30% for the year. At least at the end of last quarter. And a lot of this has to do with the commodity price inflation that Jessica mentioned. Obviously the conflict in Eastern Europe has helped fuel some strong earnings growth and performance for a lot of names in that sector. Next slide. Yeah, so this slide shows returns for various investment styles for the year relative to the broad market. I'll underscore the fact that these are relative returns. Obviously, most of these styles are negative, but you know, obviously you can see here it's been a relatively strong year for value. That factor is performing very well relative to the broad market. This slide should make a lot of sort of intuitive sense to folks. I'll point out the low vol factor, which has also exhibited some positive relative returns. We would expect that. Low vol indices are mostly comprised of more defensive-oriented names that hold up well, typically hold up well during drawdowns. I guess the one interesting part of this chart to maybe point out is the kind of flat to negative performance of the quality factor in the last few months. Might come as a surprise to some people. It's actually worse in international markets. Quality is one of the worst performing factors on the non-U.S. side, but it might be confusing to people. Some might expect sort of a flight to quality amid this sort of broad market pullback. I think a lot of the reasons have to do with sort of the macro environment kind of driving investor sentiment in recent time. You know, we talked about, you know, inflation, conflict in Ukraine. A lot of that has kind of given rise to a cyclical rally within the energy space. And, you know, as we know, a lot of those names are of lower quality, at least from a balance sheet perspective in that sector. And so I think that's part of the reason why you're seeing more muted relative returns for that factor in recent time. Go to the next slide. Yeah, so this is a really interesting slide. This slide sort of decomposes calendar year performance for the S&P 500 index into three different components. So you've got the return that's being driven from earnings growth, you've got the return from the dividend component, and then the change in the price multiple. And you can see that the dividend component is usually the smallest of the three. So really it's the earnings growth and the valuation multiple change that we're going to be looking at here. And you can see that, you know, in 2019 and 2020, the S&P was up, you know, close to, I guess, over 18% in both of those years. Pretty much all of that was being driven by the change in the valuation. You can see that earnings growth was flat in 2019 and obviously significantly negative in 2020 amid COVID. So it was really the multiple expansion that was driving all of that return. And, you know, obviously that was due to the low rate environment, people piling into stocks after the COVID drawdown. Fast forward to 2020, that dynamic changed a little bit. You still had very strong return for the S&P 500, but a lot of that was due to the earnings growth of the underlying components of that index. After the low COVID comps, the multiple actually got re-rated, and there was some multiple compression going on that year, but again, still positive returns for the index. Fast forward to the first half of this year, you know, you've got the re-rating the multiple, but earnings growth obviously has not been as strong, you know, as it was last year. Obviously still positive, but you know, the multiple contraction has really driven that poor return for the S&P 500, at least in the last few months. The forward PE on that index is now below its 10-year average, and that was, you know, it's a far cry from where it was just a year or 6 months ago. And if you want to maybe look ahead, you know, obviously no one knows for certain where equity returns are going, but if you think about performance within this kind of decomposition framework, you know, obviously the multiple is going to continue to face some pressure given where rates are likely heading, at least in the near term. And earnings growth is only going to continue to slow, I think, for most indices, especially if we, you know, go into a recession. So I think that's maybe reason for some caution as it relates to expectations surrounding equity performance going forward. Next slide. Okay, so I'll maybe round out this section by focusing on the current equity risk premium, which is calculated as the earnings yield in the S&P 500 minus the 10-year Treasury yield. And this is basically a measure of attractiveness of U.S. stocks relative to bonds. And as you can see, you know, the premium is still positive due to the solid underlying earnings for the index, despite the fact that Treasury yields have ticked up in recent time. In terms of the go forward, you know, if the long end rates continue to rise, that could add some pressure to the premium. And obviously, if earnings see significant deterioration, that would also be problematic. You know, there's been a lot of talk about whether or not we're going to be going into a recession anytime soon. I'm not here to opine on that, but I think it's important to point out that during periods of recession, the S&P typically sees a peak to trough earnings decline of about 15%, which is within the margin of safety in terms of keeping this premium positive But it's certainly something that we're going to be watching going forward very closely. And with that, I'll turn it back over to you, Greg.
Thanks, Evan. Yeah, you led with this discussion saying that there's going to be more bad news than good news. Sadly, that's kind of been the theme for U.S. equities. But I think a point worth making too is that just about every client of ours is a long-term investor, and mean reversion is an actual thing that numbers do over the long term do kind of approach a long-term average. And we all know that U.S. equities, that's a positive equity risk premium, and equities tend to be accretive or have always been accretive over long time periods and portfolios. We expect that to be the case, so we encourage investors not to overreact to what's happened during the first 6 months of this year. So that's the story on the U.S. side of things, and then I'm going to hand it off to David Hernandez to navigate the same conversation for non-U.S. equities. David, all yours.
Thank you. So first, I'm going to talk a little bit about what's happened this year, and then I'll discuss some forward expectations in the shape of risk and opportunities. In the second quarter, global equities faced continued pressure as high inflation persisted in developed markets and the risk of a recession grew. So as a result, volatility levels halfway through the year are now on pace for 2009 levels. The US dollar strengthened as the Fed raised rates at a faster pace than expected back at the beginning of the year. And Chinese equities bounced back after 4 straight quarters of negative performance and were one of the lone bright spots in markets. Now, broad equity indices submitted double-digit losses in the second quarter. We can see the performance on the next slide. And small caps underperformed large caps in this very risk-off environment. As Evan said, there was no real place to hide as all major style factors as well as sectors produced negative returns in the second quarter. Emerging markets did outperform developed markets, and they were supported by smaller currency losses as well as the rally in Chinese equities. And we'll talk more about those two issues a bit later with some charts. Now, it's been quite a volatile start to 2022. If we look at the number of days with a 1% move or greater, we're trending well above 2020, which was the COVID-19 sell-off, and we're very close to pacing for 2009, which is the period coming out of the global financial crisis. Now, unfortunately, we do expect volatility to persist in the second half of the year. Now, in the first half of the year, we also saw the US dollar strengthen, particularly in the second quarter. Year to date, the EFI currency return detracted 9.7%, while the EM currency return detracted 3.9%. Now, I think it's kind of interesting to see EM currencies hold up better than developed market currencies. And this is really the result of a wide divergence between US monetary policy and policy in like Europe and Japan with the ECB, as well as the Bank of Japan or the BOJ. In the second quarter, almost every single country equity index produced negative returns except for China and Hong Kong. China ended its 4-quarter losing streak and posted a positive 3.4% return in 2Q. Here, the market sentiment shifted as Chinese government announced new stimulus measures. They also provided some comments to help assuage regulatory concerns that had persisted for roughly a year now. Now, speaking about China, let's take a look at some of the opportunities and risk for the second half of the year. Now, I want to start by saying that I'm more concerned about the short-term risks than I am excited about the short-term opportunities, but let's start with the positive. We think China has a chance to bounce back in the second half of the year as the Chinese government shifts to more accommodative positions. We think this can help emerging markets outperform developed markets, particularly those outside the United States. Valuations are looking pretty attractive for non-U.S. equities, and I think this sets things up pretty well for medium-term returns. On the risk side, recession is a real possibility, especially in the Eurozone, and central banks will need to navigate high inflation and slow growth, which is a very challenging task. Now, based on expert estimates, the Eurozone has seen the chance of recession increase considerably since the start of the year, and they started off around 20% expectation on recession. Now they're north of 40%. And most major markets have also seen recession risk increase if you think about the United Kingdom, Japan, as well as the United States. So unsurprisingly, we've seen economic momentum slow down in developed markets. Here we're looking at the Purchasing Managers Index. This is an economic indicator where a reading above 50, or this dashed line on the chart, a reading above 50 indicates economic expansion, a reading below 50 indicates economic expansion. Over the quarter, developed markets, the composite PMI fell from 55.9, a very robust number, to 52.5, still in expansion territory, but a loss in momentum nonetheless. In contrast, emerging markets PMI, the composite rose from 43.5 over the quarter to 55.2, and this was largely due to China's economic rebound as they pulled back on some of the lockdowns that were plaguing them in the end of first quarter and early second quarter. Now, if economic activity continues to slow for developed markets, it presents quite a challenging problem for central banks that are dealing with record high inflation. And what compounds this issue for developed markets is that they began their rate hike cycle much later than emerging markets, roughly about a year later. And as a result, the hikes that have been in place, and a lot of this is coming out of the United States, the hikes have been much steeper. And so there's also much less room to cut from here should economies falter from a growth standpoint. Now, on the bright side, valuation levels have become fairly attractive for non-U.S. equities. This is our composite metric, which is an average of 6 metrics we've listed out here. On the developed market side, the ranks in terms of where they rank in the 20-year history are in the top quartile of cheapness. So there's some attractiveness. On the EM side, it ranks in the 36th percentile, which is also attractive. And if we think about what's happened this year, we've seen these metrics fall considerably. So here we're looking at the forward PE ratio, and they're approaching at or below the March 2020 lows. So these valuation levels we think are appropriate given the risks that are in the market today, but we do think that this provides a good foundation to build on for strong medium-term returns into the future. Now let's summarize the non-U.S. equity section. Markets, they're facing higher inflation and slower economic growth. That's a challenging environment. Equities sold off. China was one of the lone bright spots in the second quarter. Central banks, they're going to be challenged to navigate this environment. You have recession risk that's increased since the start of the year. We do think that Chinese equities have the opportunity to bounce back after about a year and a half of underperformance. We do think developed market equities, particularly outside the U.S., will continue to face pressure for the rest of the year. But valuations, they are attractive, and we think that sets up a positive outlook if we're thinking about the next 2 to 4 years once we move past some of the current market issues today.
Thanks, David. And from a valuation perspective, we look just the numbers on U.S. attractive versus long-term history. But I think every investor will have to kind of qualitatively consider the overhang of the odds of a European recession. Counterbalancing that is the momentum China's starting to show. So again, a lot to consider. No one direction forward here, but certainly the medium term, there's an opportunity for returns to be attractive in the non-U.S. side. That really concludes the traditional conversation, meaning traditional asset classes of fixed income, U.S. equity, and non-U.S. equity. And we're going to move now to the alternative asset classes of this morning's discussion. And we have hedge funds, real assets, in private markets to cover. We'll start with hedge funds, and Chad Schaefer is going to take us through this section. So Chad, all yours.
Thanks, Greg. So turning to the first slide here, hedge funds were down in the second quarter, but they outperformed risk assets broadly across the board as they've continued to weather the storm throughout the year. In the first half of the year, the HFRI composite was down 5.9%, but when you compare that to equities, the S&P down 20% and the ag down over 10%, they've actually done pretty well to protect investors. They haven't been immune from challenges, as we've seen across risk markets. They posted negative returns for the first half of a calendar year for only the second time since 2010. But on a relative basis versus equities, this is actually the strongest period of outperformance for hedge funds, dating all the way back to the inception of the HFRI indices in 1999. Drilling down into relative performance of hedge fund strategies, macro-oriented funds posted slight declines in June as commodity prices retrenched from previous highs. We kind of talked about that earlier. But macro has actually led all hedge funds throughout the year. They posted positive gains on the quarter and year to date. So they've actually done pretty well in this environment. Merger arb and event-driven funds were down on the quarter. Spreads widened over concerns of rising rates and the potential for a recession, which could cause a slowdown in M&A activity going forward. However, investors were also concerned that some recent deal repricing could become more widespread across other announced deals, though ultimately I think those risks are pretty limited to actually come to fruition. Equity long short has been much more challenged throughout the year. A lot of the factors driving the markets have been macro, top-down oriented. This creates a difficult environment for fundamental bottoms-up stock pickers. Actually, on the long side, alpha was positive in June, but negative alpha throughout the year on the long side has really been a headwind that's dragged down performance in long short. Still, equity long short only captured about half of the downside in equities on the second quarter, and that's mostly due to conservative positioning, which you'll see on the next slide. This slide shows gross and net exposures in U.S. equity long short funds. Most managers have reduced exposures throughout the year, reflecting increasing caution amid ongoing volatility in markets. It's notable that in June, net exposures hit about 35%, which is the most conservative positioning we've seen since the financial crisis. So it just reflects overall conservative nature of the hedge.
It looks like we may have lost Chad. Chad, are you still there?
Oh, I am. Can you guys hear me?
Yeah, sorry, we lost you for a minute, but right back to you. Yep.
Sorry, I apologize. I'm not sure where I fell off, but starting on this slide here with hedge fund performance at the composite level, this chart shows the fund weighted composite, which is an equal weighted representation of the hedge fund industry, and that's compared to the asset weighted composite, which is skewed towards larger hedge funds. Generally, smaller size hedge funds have an advantage. They can be more nimble, can shift exposure more quickly for the opportunity set. And this has been true for the last several years, where the fund-weighted composite has outperformed in 5 of the last full calendar year periods. However, larger funds tend to protect better in equity dislocations. We've seen that this year. The year-to-date outperformance of the asset-weighted composite is actually the largest we've seen dating back to the financial crisis. The reason for this, many large hedge funds have benefited from a more diversified base of underlying strategies. So think of multi-strats and different components to that. And this often includes quant and macro strategies, which have done well in this environment. Turning to opportunities and risks in hedge funds, the opportunity set for long short funds is ultimately mixed. High dispersion and uncertainty is generally good for stock pickers to generate alpha on both longs and shorts. However, on the flip side, I talked about positioning from a gross and net exposure standpoint. Hedge funds are much more conservatively positioned today, which has provided downside protection, but could also limit upside participation if we have a meaningful equity rally from here. In credit, opportunities in long short are becoming more attractive. Frank talked about spreads widening to much more attractive levels than we've seen. We continue to favor structured credit opportunities as an alternative to fixed income. These strategies offer attractive yields, limited downside risk, and actually benefit in rising rates. On the distress side, higher rates and macro headwinds should create more opportunity, but we haven't seen that come through to fruition yet. Default rates are still at historically low levels, and there's limited opportunities in the distress opportunity set at this time. I'd also note that distress cycles tend to be relatively long, so we think it's prudent to remain cautious here and wait for a better entry point as opportunities in distress should ultimately come to fruition if there really is a recession in the second half or beyond. Turning to event-driven, I'll highlight this on my next slide here. This slide shows the M&A environment in the first half of every calendar year dating back to 2012. The first half of this year has remained remarkably robust despite all the headwinds we've talked about on this webinar. Activities behind what we've seen last year, but it still has exceeded 2.2 trillion in announced deal activity. This is largely driven by large and mega cap deals. About 2/3 of the deal activity announced this year have been for deals of 1 billion or greater. So just this reflects the significant dry powder in private equity. Corporate balance sheets continue to remain strong with cash on their balance sheet to make formative transactions. And supply chain disruptions have forced some companies into vertical integration. So I continue to think these will be strong headwinds for the rest of 2022. And I would expect this strong deal activity to be as strong as the first half or greater, just given the risk we see and companies trying to address those through acquisitions. So this is ultimately positive for merger arb and event driven. I think there's plenty of opportunities to generate returns throughout the year. And I'll kick it back to Greg.
Thanks, Chad. From having done these for a number of years now, a lot of years, a lot of quarters, it's been a kind of a difficult story to tell for hedge funds, but this is certainly a different story now. Hedge funds really delivering upon the expectations of being with the weather market volatility as rates have gone up, as equity market volatility has been elevated throughout the years. So not only have they been a good place to kind of hide from the storm the last 6 months, but based upon Chad's comments in the slide shown here, there's certainly opportunity going forward for the remainder of the year as well. So that concludes hedge funds. We'll move over now to real assets, and we're going to cover both real estate and infrastructure in these sections. So I'll pass it to Josh.
Thanks, Greg. Starting off here with performance, commercial real estate has continued its torrid pace in the first quarter after a dip during the pandemic. You're going to start hearing some whisper numbers around 4 to 7% in following quarters, so you'll see some sort of normalization going forward. Record high occupancies and rents in industrial and multifamily continue to fuel income growth. However, inflationary concerns and multiple interest rate hikes may exert downward pressure on valuations. Looking at cap rates here, while the Fed's recent actions have lifted interest rates broadly, cap rates remain low. Valuation impacts differ by sector as cap rates hold steady in industrial, multifamily, and more favored segments of office and retail. However, rental growth in the most favored property segments should be strong enough to offset any asset value impact, although some level of degree of correction is likely this year. Focusing on interest rates, centered on curbing inflation, the Fed has alluded to multiple interest rates hikes this year, exerting upward pressure on cap rates in the short term. However, historically, a high interest rate environment has led to stronger demand in commercial real estate and higher NOI growth, offsetting any negative impact on valuation and financing obstacles. Taking a look at rental patterns, given the record low level of vacancy, rent growth is poised to continue well ahead of inflationary patterns for most property sectors. Industrial rent growth has topped 20% in many supply-constrained markets. Multifamily rent growth has moderated in June as expected, but remains healthy for the overall market. And then office and retail rent growth ticked up slightly in most gateway markets as COVID concession packages have burned off. Wrapping up things here with yield advantages. Despite the economic and geopolitical headwinds, the durable nature of real estate cash flows position the asset class well in a period of global volatility. NOI growth driven by shorter duration leases in multifamily and retail should be one of the main drivers of returns going forward. So you'll see more of an emphasis on NOI growth going forward versus cap rate compression. Moving on here to infrastructure. Over the past 18 to 24 months, infrastructure has shown to be a resilient source of long-term risk-adjusted returns, a portfolio diversifier and stable source of yield amidst geopolitical landscape and inflationary concerns. Moving on to the transportation sector, air travel, particularly in the leisure space, has seen a significant rebound since the pandemic slowdown. The recovery is close to 2019 traffic levels this summer, and one should expect an increase in demand for short-term flights with low-cost carriers. Finishing up here with the income benefits for infrastructure. Given the current inflationary environment, core infrastructure continues to emerge as a safe haven for yield-starved investors. The current environment has allocators seeking out infrastructure assets for defensive inflation protection, low volatility alternatives, and stable cash yields.
Thanks, Josh. It's certainly that trend for moving assets towards infrastructure, I think, if nothing else, the last couple of years, particularly this year, has accelerated that pace, and that will only continue going forward, especially when we consider how much infrastructure investment needs to take place both here in the United States as well as abroad. And then circling back to real estate has long been a constituent in almost all of our client portfolios. Again, it's stars shining bright here as rates have gone up and inflation has been high, as again, a place to shelter from the storm amidst the higher rates and equity volatility. With all that said, now we've reached the last two sections of the discussion this morning, and this is really private markets with private equity, private credit. Been a lot of movement into these asset classes over the years as a result of a number of factors, and the last 6 months have only kind of increased the appetite for private equity and private credit. So with all that as a preview and background, Brett, I'll hand it to you to work through these last two sections.
Thanks, Greg. Starting with private equity and reporting on a lagged basis, private equity performance it continued to be strong in the fourth quarter 2021, up over 7.5%. Overall time periods, which includes the 1, 3, 5, and 10-year periods, global private equity and North American private equity outperformed public indices, which include the MSCI Equity, the S&P 500, the Russell 3000, and finally the Russell 2000 Growth. Breaking down performance on a year-by-year basis, private equity performance continually outperforms the Russell 3000 public market equivalent. Additionally, as gleaned from the graph, more recent vintages such as 2017, 2018, and 2019 tend to be more disparate performance across top and bottom decile managers, but over time, that performance range compresses as annual performance across managers gets closer to the median IRR on an annual basis. 2021 was a record year for private equity deployment, which was supported by a challenging year in 2020 caused by the COVID pandemic and the low interest rate environment, which saw a glut of managers look to sell portfolio companies and take advantage of increasing purchase price multiples and cheap debt. Activity has cooled slightly in the first half of 2022 as inflation and rising rates have been a headwind for new M&A activity going forward. Similarly, venture capital deployment activity broke records in 2021, almost doubling the previous record in 2020. Much of this activity was driven by record highs in public market and the accommodative IPO market. Furthermore, 2022 has been substantially more muted year as the public markets have sold off significantly through the first half of the year, and the IPO markets are meaningfully less attractive than what they were a year ago. We expect this trend to continue through the end of the year as early and late stage valuations retrench in this rising rate environment. Private equity transactions continue to occur at a significantly lower valuations than public equity valuations. Though the spread has narrowed with public market pullback, small buyouts continue to benefit from inefficiencies and growing demand from capital raised by larger funds, creating a strong exit environment with multiple expansion opportunities. Large private equity and late-stage venture valuations are most aligned with declining public market valuations and are under pressure as private equity firms consider their business valuations for the second quarter 2022. While we recognize that there are market risks that could challenge private equity and venture returns, that being said, we believe there are pockets of the market where value remains, such as lower middle market buyout and early-stage venture. We believe long-term focused investors will benefit from a return and diversification standpoint to a dedicated private equity and venture allocation within their portfolios. Moving to private credit performance, and once again reporting on a lag basis, private credit finished strong in the fourth quarter 2021, exceeding all public fixed income and equity indices except for the Dow Jones Industrial Average and the S&P 500. Alternatively, over the 1 and 3 year periods, private credit has lagged most public equity indices, but has outperformed most public fixed income indices over that time period. Looking to the 5 and 10 year time horizon, private credit performance has been up to expectations, producing strong returns, exceeding most public fixed income indices, but lagging the overall equity markets. Overall, the return and yield premium achieved by investing in private credit remains a return driver and a risk mitigant for the asset class in a rising rate and inflationary environment. In 2021 and now in 2022, inflation has emerged as a top threat for investor portfolios and a threat to the market. Private credit provides a viable option to help investors mitigate risk within their broader portfolios. Private credit offers protection against inflation as returns are generated from interest that is based on a floating rate, LIBOR or SOFR. The floating rate nature of this loans means that if inflation causes short-term interest rates to rise, investors can be protected. Floating rate loans are highly likely to outperform fixed rate bond allocations in this rising rate environment. Sponsor-backed deals, meaning those that are owned by private equity managers or companies owned by private equity managers, have continued to provide downside support through the most challenging markets. Looking at the worst period of the great financial crisis and the COVID pandemic, private equity-backed companies were nearly 50% less likely to default to non-private equity-backed companies. Sponsor-backed strategies provide investors with strong core holding to an overall private credit portfolio, allowing investors to allocate to more tactical strategies as a satellite or complementary position. Overall, private credit performance was strong through the fourth quarter 2022, as performed up to expectations over the past decade. Most importantly, the asset class continues to prove itself as a value add to institutional portfolios. The need for private credit remains strong as companies, both private equity backed and non-private equity backed, are in need of capital to finance new acquisitions or refinance existing debt, all against the backdrop of the lack of bank participation in the market that has continued since the great financial crisis. Being top of the capital structure and earning a yield above traditional fixed income remains a key selling point for current and prospective investors. While these factors will continue to drive the asset class and attract new capital and new market entrants, we believe fundamentals remain intact and see many benefits for investors to include private credit alongside their existing fixed income and equity portfolios. Back to you, Greg.
Thanks, Brett. A really strong summary of private equity and private credit and reasons why those asset classes have delivered strong returns, and the expectation is those will continue to be accretive components of investor portfolios. So that wraps up the formal commentary we prepared across the U.S. economy and asset classes. And we'll move now to the Q&A session. I encourage any listener to submit questions via the Q&A button on your screen. What we want to lead with, though, is some questions that we've gotten from clients, and in many cases, we've gotten these questions from more than one client. So we made the assumption that if some of our clients are asking about it, they'd be logical questions to discuss as a broader group here this morning. So we're going to just march down this list. There's one other question on here which is not on here, but we've gotten a couple times, which I'll also include with this. But the first one is if rates are going up, and Frank, this is going to you because it's really a fixed income question. If rates are going up, should we be shortening duration in our fixed income portfolios?
Sure, thanks, Greg. So I would say the answer to that is no at this point, unless you have a really strong belief that not only are rates going up, but are rates also going to go up faster than the market already expects. I know Jessica had put a chart earlier in the presentation showing what the market is already pricing in. So if you want to take advantage of that, you not only need to see the rates go up, but they need to go up more than what the market has already priced in. The second reason why I would say not to do that is your duration is really your hedge to risk assets. So by stripping out your duration and shorting duration, if everything else is going bad in your portfolio, if you don't have your duration in your portfolio, you lose that hedge. So I would recommend you staying the course and keeping your duration as set with your long-term policy.
And for those listeners or attendees today who want a little bit more detail on this, we actually did publish a newsletter on this earlier. I think it was late June is when that went out. So that's available on our website if you want a little bit more information, some data to support the comments Frank just shared. Let's move on now to some questions about U.S. equities. And Evan, we're going to put you in the hot seat here with a couple of them. The first one is why are rising interest rates more of a headwind for the performance of growth stocks and not so much of a headwind for value stocks?
Yeah, no, it's a good question. If you think about it from like a theoretical standpoint, so think of the price of a stock as just the sum of its future cash flows discounted back to the present at an appropriate rate. Obviously, growth stocks by definition have a more significant portion of their cash flow stream kind of far out into the future, whereas value stocks, you know, their cash flow stream is more stable throughout time or maybe even more front-end loaded. And so as you adjust the discount factor either up or down, it has an outsized impact on those cash flows that are far, far down the road because you're discounting them back several years to get back to the present. So as you increase the rate at which you're discounting those cash flows, you are decreasing each term in the series and decreasing, I guess, the overall sum. Hopefully that makes sense.
Yeah, it does. Yeah, I'm a math guy, so DCF, right? Discounted cash flow, higher interest rate, further out in time those cash flows occur, they'll lower the price today. So makes perfectly good sense. And then Evan, you know, you led your discussion with with sharing that it's mostly bad news on the U.S. equity front, are there any reasons to be positive about near-term prospects for U.S. equities, or are really playing the long game here and need to be patient?
I mean, obviously, yes, play the long game and be patient. I'll maybe point to a couple things that might allay some concerns. Number one is earnings. I mentioned they're slowing, but they're still positive. We actually got some good numbers in yesterday, at least relative to maybe some expectations. And even in light of souring sentiment, forecasts for the S&P from an earnings perspective for the calendar year sort of still in line now with where they were at the beginning of the year, right around 10%. Year over year. So that's a bright spot. Inflation is likely topping out, as Jessica mentioned, which means the Fed could pull the lever on rates as soon as sometime next year to foster a more kind of growth-oriented environment. And then finally, I think it's important to mention that equity markets are pretty much always forward-looking, meaning that even if the next GDP print is such that the U.S. officially enters into a recession, I question the extent to which that is already sort of priced into current markets. And that's happened a lot throughout history, where once the recession officially takes place, the damage in equity markets has sort of already been done, and we know about recoveries kind of following shortly thereafter. So that might be kind of cold comfort for people, the way that things have gone so far this year. But those are the things that I would point to for people who are looking for a little bit more optimism in their lives at this point.
Thanks, Evan. Question on non-U.S. equities. This is actually not a question on the screen, but something that has come up multiple times and was brought to me this morning is something we should really discuss. Is talking about relative performance of non-U.S. equities, small caps versus large caps, and more pointedly, why are small caps underperforming large caps this year? David?
Yeah, so non-U.S. small caps, it's an asset class that we follow, and we followed for 10 plus years now. It's kind of part of our standard asset allocation framework. And this year, small caps have underperformed. If you think about reasons why they've underperformed, it's not uncommon for small caps, and you'll see it on the U.S. side as well. When it's a very risk-off environment, small caps tend to be considered more risky, which can lead to some underperformance. And then particularly the type of risk-off environment that we're in, where there's concerns around economic growth, there's concerns around recession. Small caps tend to have more local exposure to revenues and customer bases. And so if you have a lot of small cap non-U.S. stocks based in Europe, and there's concerns around what's happening in Europe, and you have companies that are more multinational, large cap stocks, some of the issues that have been happening this year are going to hit small caps more. And I think that's why you have some of the underperformance that you've had from small caps compared to large caps.
Let's switch over to real assets here, and specifically let's hit real estate first. Josh, as you see here today, the story's been pretty good on real estate as a whole. Are there any challenges, particularly just as it relates to the macroeconomic environment, or maybe more specific factors to the real estate environment, that real estate investors should be aware of and perhaps even need to navigate around it on a go-forward basis?
Yeah, that's a good question. I would say higher inflationary trends, continued Fed rate hike increases, labor shortages, and supply chain disruptions. Those factors continue to be headwinds for real estate investors. However, kind of given all that, look for core plus, value add, and opportunistic managers. Look for them to have the luxury to enter distressed opportunity sets at unlevered price points. A lot of our managers are fundraising. They're planning to buy during the dip and then have those high realizations after.
And then staying in the real assets world here and thinking about infrastructure, what are some of the most compelling opportunities within the infrastructure asset class?
Yeah, I would say, institutional investors are expected to increase their allocations to infrastructure, kind of taking advantage of promoting the shift towards smart technology, digital demand, ESG initiatives, and clean energy. As market volatility is expected to increase in both public and private markets, infrastructure's strong returns are attractives. Their yield advantages should be able to accelerate a shift in allocations from current fixed income exposures.
Thank you. hedge funds, Josh, this is a question that we've gotten a lot. It's kind of waxed and waned in terms of frequency of question. But as investors think about hedge funds, and clearly hedge funds have been kind of up and down sentiment wise with investors over the years. But big picture, long term, how should investors think about hedge funds as an allocation within the context of their full portfolio?
Sure. Yeah. Thanks, Greg. It's a good question. I try to think of hedge funds as a ballast on portfolio. We see hedge funds, they were down this year, but they still protected and buffered the downside versus equities and fixed income as well. In an environment with dispersion, uncertainty, a lot of things going on that can play out in different ways, that actually creates a lot of opportunity in both long and short to add alpha. It's one area of the portfolio where you should be able to see that over time, especially on a long-term time horizon. I also like to think of hedge funds as a nice complement to traditional fixed income. Things like structured credit, multi-strats, event-driven, merger arb, all of those things provide a relatively stable return profile, limited downside risk, and again, ultimately ballast to a broader diversified portfolio.
Yeah, I think hedge funds really can add some stability across different asset classes, right? As you think about them within the context of some of the primary anchors in institutional portfolio, such as equities, such as fixed income, and what they can do there in terms of kind of preserving value and adding some stability to it. So I could not agree more with that. Last two questions, private markets, Brett, they're both yours. Let's touch on private equity first and how valuations have changed since COVID. Just as a little bit of background, clearly that valuations were sky high for many, many years. There's a lot of dry powder in the market, and PE funds were chasing a limited number of available deals, which is driving valuations and multiples up. But how have you seen that change over the last 2 years?
Yeah, absolutely. And I think from a year ago, but in particularly 2 years ago, those dynamics still exist where there's plenty of capital in the market, still search for deals, a lot of dry powder. That being said, with the headwinds and the volatility in the market today, we do see bifurcation in the overall market, just given that high quality deals are still being done at higher multiples, north of 15, nearly 20 times, in some cases, north of 20 times. That being said, other deals that may be more complicated or might be challenged due to rising interest rates, those deals are getting done now at lower multiples, or in some cases, those deals are not getting done at all. So the market is absolutely cooled. The growth of valuations has begun to plateau. But that being said, there are still areas of the market where private equity managers continue to pay high multiples for high quality assets.
And then let's loop in two of the real macro themes that we talked about today across asset classes. Jessica led with them, and they really manifested themselves in each section one way or another, of inflation and rising rates and what that means for the private credit world. Again, this is a new environment for everyone. I think in the private credit world, particular, given the amount of floating rate exposure there is within the private credit world. Talk a little bit about how both these factors have really changed how managers approach how they approach and underwrite deals.
Yeah, in the challenge is collecting data, just given there are fewer or no investors who are still around that invested in the late 70s or early 80s when there was a rising rate or inflationary environment. So they're relying heavily on more recent data from private equity firms and private credit managers. Instead of looking at the last 12 or so months, instead they're looking or weighing more heavily the data from the past 2 or 3 months to kind of understand the growth and trajectory of the business. Absolutely, rising interest rates are increasing borrowing costs for businesses, but we don't see them straining the overall liquidity of these businesses. But understanding how inflation impacts customer demands and so forth, and the duration of inflation will kind of be contingent or on how deals get done in the future, and just the amount of deployment we see for the remainder of 2022 and especially in 2023, if inflation continues to play out.
Thank you. Well, we're pushing the top of the hour here. I promised everyone, all of our attendees, that this would be 1 hour, and I don't want to run over the hour. I know other questions have come in. My apologies, we cannot cover every one of them. What we will do is look at those questions and follow up with as many of you as possible to answer those questions. And again, I apologize, we don't have time to cover every single question that came up. Bottom line, I hope this has been a good use of your hour and helped everyone understand a little bit more what's happened and also what to expect for the rest of 2022 and beyond. If you have additional questions, there's an email address listed right here on this page, research5@marquetteassociates.com. For those of you who are our clients, feel free to reach out to your consultant or any of us who presented today. We are all available and more than happy to discuss topics that were covered this morning. Again, thank you very much. We hope this has been a good use of an hour, and we'll see you next time. Thank you. Goodbye.